Another thing that we hear a lot is people will come to us and say, I can't buy a house, I need 20% down.
20% down.
I got to wait till I get 20% down. So what's the big deal with 20% down? Where's that coming from?
Well, there's two things. So we'll touch first is just down payment. Traditionally, 20% in the day, without saying dates, that's what you had. You had a 20% down payment to buy a house. And over the years, FHA's come along and these other programs that have reduced the down payment obligation, and the whole intent is to make home ownership more affordable. Now, no, you don't have to have 20% down anymore. And so they're trying to make it to where people can get into homes that didn't. Because you guys know that housing drives the industry. Housing drives the economy.
Right.
When you build and buy houses, it keeps people employed. So they saw it early on and decided 20% down is somewhat unachievable. So now we have these other programs. So there's a lot of factors that play into it. And that's, I mean, we could talk for 30 minutes on different down payment options. But again, like we talked in the last segment, work with a lender that knows the options. Here in Alabama, and every state has it, but Alabama, we have what's called a bond loan, which we've got a government organization that helps pay and finance a down payment. So technically, there's a couple programs you can get into a house with no down payment. Yeah. Is it the right choice for everybody? Probably not. I mean, it's good to keep your cash, but some people need the help, and it's there. So 20% isn't what it used to be. I mean, it's good if you have it, and it's good if you don't need it. So say you're flush with cash and you've got no debt and no student loans and none of this other stuff, and 20% down is great because you'll have a lower mortgage payment. You'll have no mortgage insurance, obviously, but for a lot of people that's not really the option. A lot of people, they've got a high interest credit card, they've got a car loan, they've got childcare expenses, so having the cash in hand is probably more significant than having the lower loan amount. And it's, again, work with a lender that knows, and we're not financial advisors, but we can give you information to help make a decision. If you do work with a financial advisor, you can take our worksheets and our forms to them and say these are the proposals, but 20% is not the standard by any means. And I got to say, the number of 80% loans, so loan to value is how much you borrow based on the value of the house. So $100,000, $80,000 is 80% loan to value or 20% down. The number of those loans I do compared to 90, 95, 97% is just a fraction. So we don't see 20% down as much. You get into investment properties, you get into second homes, obviously the down payment's higher, and it's a different conversation. But just for the average home, the home you're going to live in, 20% down's not the way to go for a lot of people. Right. And so the other part of that equation, to answer your question, part two, 20% down, mortgage insurance. I get so many people call and say, I need to put 20% down so I don't have mortgage insurance, which... Nobody wants to pay insurance until you need it. Right. Mortgage insurance protects the lender because you've got less of an investment in the house. So it covers the lender should you foreclose, should you lose the house. It gives us some insurance. It doesn't help the buyer in any way other than just allows you to put a smaller down payment. But mortgage insurance isn't as evil and as bad as everybody thinks in some cases. Right. So conventional financing, good credit, 10% down, depending on the loan amount, you might spend $30 or $40 a month on mortgage insurance, but be able to keep 10% in liquid cash and not put it down. So obviously your payment goes up, other factors, but in and of itself, mortgage insurance isn't necessarily a bad thing. It's a tool. Right. And so when you're talking about...
Because $50 a month coming out of your pocket versus $20,000 a month is a lot easier to swallow.
Absolutely.
Over however long that term of your loan is.
And mortgage insurance can go away on a conventional loan, so there's all these things. You can refinance or whatever, but no, exactly, you're right. If it were me, is putting the 20%, and granted, you got more equity in the house, which is good, but you're going to gain equity naturally by the market. It's proven. Even in downtimes, houses appreciate. Taking, say, $20,000 down, or $30,000 or $40,000 down in some cases, yes, it's going to save you money putting it into the house, but that cash is a big deal.
Yes.
I mean, cash.
Well, I mean, at $20,000, your payment's $2,000 a month. I mean, you've got 10 months or so already sitting there for a payment where an extra $50 a month is nothing compared to the liquid equity you already have.
You can put it in investments and not necessarily get the same yield, but still you can make money on that money. It could be a rainy day fund. You could put it into your house. You can have renovations done and work done to improve your house. Yeah. There's so many things you can do with it, and it's just really a fact of don't let mortgage insurance scare you, and it's also like interest rates. It's dictated by credit scores and other factors, and that's your lender's going to walk you through it. There's not an easy calculation to figure out mortgage insurance.
Right.
FHA it's a standard factor, but for conventional, for most borrowers, I can't just rattle off your mortgage insurance amount. There's multiple carriers, and we work with those in multiple ways to calculate it. But the point being, don't let not having 20% down deter you from looking at buying a house.
Yeah.
Rates are still good. I mean, and this may not age well. Who knows with the way the market is? But as of right now, rates are still historically good. And if you're paying a little mortgage insurance to allow you to either buy a house sooner and start building your portfolio and your equity and your growth financially sooner,
Right.
as opposed to save. And I got to tell you, everybody's tried to save that money up for an Xbox, a car, a house, whatever, and bills come up. It's hard to save.
Right.
So
Life happens.
Yeah, life happens.
Right.
And so to be able to purchase a house with, I mean, there's some awesome programs for first-time home buyers that actually have reduced mortgage insurance, but that allow like 3% down payment. And so long as your budget allows for it, and so long as you're able to do it, you're going to find out a lot of times it's cheaper than rent.
Yeah.
I mean, it's a statistic that you can look at. Rent's going up at a higher rate than mortgage and housing.
Yep.
It's just what it is. So you're paying less than you are in rent. You're not having to save up an additional 17%, and you're building equity in a home that at some point you'll be able to tap into.
Right.
So the 20%, it's not a myth, it's a fact, but the 20% thing and the mortgage insurance thing are two things that shouldn't be deferring you or keeping you from at least looking at it. Because the fact of the matter is, you don't know. I mean, I don't know. When somebody walks up to me off the street and says, I want to buy a house, I've got great credit, I have plenty of money in the bank, what should I do?
Right.
We won't know until we do ask the questions, and that's what's going to tell us the true answers. And it's I will say it probably a dozen more times as we go. It's having a lender, whether it's me or any of 1,000 other in Birmingham that are great.
Yeah.
A lender walking you through the process and just laying it out to you plainly, and being a consultant, being an advisor, and not just a salesperson. So those are two things that you're going to have to decide for yourself as a home buyer, if it's something that's feasible. And there is no magic answer. 20% is not the fix. It's not the requirement to either mortgage insurance or down payment.